Hello everyone, this is Ageless. All right, this very moment I will be explaining some certain concept to you as regarding ICT. All right, it is very important that you understand what this concept because ICT is the language of price and you must understand this language. And the reason why most traders why they fail in forex is because they do not understand the language of price. Price is telling you a particular story that you will need to understand, and the moment you fail to understand this story, you will end up not being profitable. I've seen so many traders come to me and they will tell me, oh, Mr. Ageless, I've been in this industry for 5 years, 6 years, 10 years, I've not been profitable. That is because they do not understand the language of price. Price, when you get into your chart, you should be able to know what price is doing, where price is heading, where price is going to what turn around. So that is why this very moment I want you to pay rapt attention to everything that I'm going to teach you right now, because now you need to understand first the first thing every trader should know if you want to be profitable. I will repeat it, let me zoom it. If you want to be profitable in this industry, there is something that you must know first. You understand? That is why I said earlier the chart is a language, and when you understand the language, you'll be able to what speak it. And that first thing that you must know is to what your PD arrays. Now, what are your PD arrays? PD arrays simply means what? Premium and discount arrays. What are these premium and discount arrays? They are your what? Your swing points in the market. I'm going to show you, I'm going to spot it to you, the swing, what swing point is, then your fair value gaps, and your what? Your fair value areas. So your swing point, fair value gaps, and fair value areas. The moment you understand it, the world of opportunity in forex industry will be open to you. You will be highly profitable. And I also want you to note that what forex trading is super easy when you understand this language, when you are able to speak it. Now let's go into it. Now, as you know, this is what a bullish price action, right? Now look at it. Look at it properly. This is a bullish price action, and you know that when price is going up, it simply means what? It is bullish. And when price is going up, or when price is being bullish, or when price is bearish, what it does is what? It creates a gap in the market called what? Fair value gap. And what is that fair value gap? Fair value gap is your three candle patterns. Let's look at it. This black one is the first candle. This big candle is an expansion candle, which is the what? The second candle. And we have the third candle, right? One, two, three. Now, in between these three candles, there is a space. That space is called what? Fair value gap. Okay. And pay attention to this fair value gap because I'm going to be explaining a lot about it to you. You understand? That will make you highly profitable. Okay. When price is printing upward, it creates fair value gaps. You can even create series of fair value gaps. Now, how do you trade with this fair value gap? This fair value gap is one of the first what arrays that we talked about, PD arrays. Okay, one we have created. Price has created what the first array. Now let's go in to what to see the next array. Now look at the next array. When price gets to this point, price decide to reverse, and the moment price reverse, and it created what swing point. That swing point is the second what array. So PD array. Now I want to establish something here. When price went up, you understand, the swing point was not created, but the moment price decide to change direction, the turning point, that turning point is called what swing point, and that turning point is the next array that price eventually what created. Can you see it? So we now have two arrays. The first one is what? Fair value gap. The second array is what? Is your what? Your swing point. Now I want to make mention of what fair value gap does. Now, do you know this fair value gap? What it does is that when price goes up and created fair value gap, what it does is what? It magnetizes price towards itself. So this fair value gap is what? Is a magnet because it attracts price towards itself. Then when price comes into this fair value gap, what it does again is that what? It will now what? Reject price. So fair value gap is also a rocket. It pushes price away. So when price gets to this point, maybe probably there is a swing point, there is an old high here that made this price to return, to reverse. The moment price begins to reverse, this fair value gap will start magnetizing the price to itself. This part is called what? Retracement. Retracement back into what? Into the fair value gap. Now, the moment price gets into this fair value gap, it will push the what? The price away. Okay, it rejects price. Now, these two PD arrays are what? Are strong rejection zones in the market. That is why you need to understand the language of price. I've been able to what? Explain one language to you that this is a gap in the market that has the tendency of what? Attracting price, then it rejects price. So can you imagine that when price gets into here now, it is an opportunity for you to now place a buy because you know that the moment price gets into it, it's going to reject it and you will start riding what? Riding the what? The market upwards. Now, also, on this swing point is a strong rejection zone too. Okay, just like what? Just like this fair value gap. If this fair value gap is strong enough, when price gets into it, it will reject price. Now, if this swing point is strong enough, when price gets into it, it will reject price what? Downwards. Okay, that is why I have been able to establish this word, these two words, PD arrays. I'll be able to explain them to you. Now, premium and discount arrays. What price does is that price moves from one PD array to the next PD array. Price moves from one PD array to the next PD array. When price moves from this PD array, which is the fair value gap. This fair value gap is called what? Discount array. It is the lower array. Okay. When price moves from here and it goes up, now price is moving towards what? A premium array. The upper array is called what? Premium. While the lower array is called what? Discount array. If price comes into this fair value gap, the moment this fair value gap rejects it, this is a what? Discount array. So price will continue to move upward toward premium array. Just like when price was going up and it got to this point, right? Now this is a premium array. If price can also move from this premium array down to what? Discount array. So that is why I have been able to establish that what? Price moves from what? One PD array to the next what? PD array. You need to understand that. That is the language of price. So don't forget these two zones are strong rejection zones. That is why look at it, examine. Can you see? When price gets here, it has a tendency of rejecting what? Price. That's why it's called what? Rejection zone, your fair value gap. And also opportunity to what? To enter the market for a buy. And when price gets here, it is also what? A rejection zone. It has the tendency of rejecting price. Okay, it will reject price and price will start what? Falling. That because it is a strong rejection zone too. So now let's take a look at it. Can you eventually see what happened? Price, this fair value gap magnetizes price towards itself. The moment price enters into this fair value gap, it rejected the price. It pushes price away. Now, this as price was going toward to this swing point, now the price enters into this swing point with full body. But just like I said earlier, this swing point has the tendency of rejecting price. As price enters with full body, it rejected price and we end up having what? This pin what? Candle. This is a rejection. So if it continue to push price downward, it will reject price and price will begin to what? Will begin to fall. Now, how do you capitalize on trading between arrays to the next array? Now, another thing you also need to know is that now when price gets to this swing point, if this swing point is strong enough, it will reject price and price will reverse and price will start falling. But if this swing point is not strong enough, it price can break through it and price will begin the market will begin to what? you will begin to what? Begin to what? Move upwards. Okay, can you see? So how do you capitalize on trading between this first array to the next array? Now that is what I'm going to what explain to you. You need to have a boundary. So when you are trading, knowing fully well that this is a fair value gap, right? And it has a tendency of rejecting price. The moment price retraces back into it, it's an opportunity for you to enter the market for a buy. Now, when you are now trading, you should be trading within this what boundary, because you should be trading within from this fair value gap to this what swing point, because you know that when price gets here, it is not certain that price will continue. It is also not certain that price will be rejected and price will reverse. So what you should do is that just place your trade here, then you exit before price gets into what the swing point. It is as simple as that. Then you will now wait to see the reaction of price within this space. If peradventure price now continue to move upward, then you will now wait for a new fair value gap to be formed. Then you enter off of that fair value gap and continue to ride it upward to the next swing point. But if eventually price gets to this place and it reversed, you understand, you would have been out of the market in profit, maybe in $10,000 profit, $20,000 profit based on your what account size. You would have made a lot of money trading from here to this very parts. Okay, so now let's take a look at it. How you would have approached this market, right? Now look at it. You place your entry here, knowing fully well that this fair value gap is going to what? Reject price. This is your entry. Okay. Now this is like a swing point, a what? A turning point. Okay. So there is no way that price will come and take out this low. So you place your what? Your stop loss below it. So which it means that what? It is safe. Your stop loss is safe here. Now you just target your 1 to 2. 1:2 is more than enough to make you super rich. It is more than enough to make you your $20,000, $50,000, and all of that. Okay, 1:2 is fine. Now, as price is going, and you see, you would have been out of the market in profit here before price rejects, before this 3 points rejects the price. Can you see the? You need to understand the language of price, what price is telling you. You need to understand the language of the market, and trust me, when you understand this, the world of what profitability will be open up to you. And in the later part of this video, I'm going to be showing you some certain things that you also need to know. So that's why, okay, now let's go into it. Can you see? Now, funny enough, eventually that same price action, price broke through what? The swing point, which simply means that what? This swing point is not strong enough to what? To hold price. So when price broke through it, now a fair value has been offered here. Okay, price went up, it came down to offer fair value. When price has offer fair value, e goes up to seek liquidity. So three swing point, price go up one, e came down, e went up. So this area fair value has been offered. So the moment price broke through this swing point, we will now wait for another area in price, area of the market, and that area, this area fair value has not been offered yet because price has not retraced down to move up. So this fair value has not been offered yet. Now this area is called what? Fair value area, because it has not been offered. Okay, so now we get to see what happens. Now I have been able to use a buzz to what? To separate the part where fair value has been offered. Now this part fair value has not been offered. Now this area is called what? Fair value area. Another swing what? Another strong point in market. Now look at the what? Look at the three pattern. It goes up, it comes down, it goes up. This is what? Fair value area. Fair value has been what? Offered here. Okay. Now I was able to also use another what? Rectangular box to what? To point it out. Now don't forget, the moment price breaks through this point, if it comes down, you understand, it's coming down into what? Another zone, which is called fair value area. This is the third what? PD array, because fair value has not been offered yet. So we wait for price to come to this zone. Now this zone has the tendency of what? Rejecting price upward again. Can you see? So when price gets to this what? Fair value area, which is another strong zone in the market, it has the tendency of what? Of rejecting price. If it is strong enough, it's going to what? Reject price. This is another opportunity for you to take another what? Another buy. When you enter off of this fair value area, then you now target the next what? Swing point. Because when price get to swing point, there's tendency that price will reverse or price will what? Will continue. So your boundary will be between this fair value area and what? The next what? Swing point. Now fair value has not been offered, so this area is called what? Fair value area. I hope you understand that. That is what? The language of what? Of price. Now let's go into our chart for us to buttress our point further. Now can you see this price action? This is chart. Okay. Now this is a price leg. Price is going up. This is what price is doing currently, right? Now let's point. We need to what? Mark out our fair value gap, because as price was going upward, as price was bullish, it created a fair value gap. Okay, now by the time you map out your fair value gap, you will see that, okay, can you see this is the fair value gap? So we will be waiting for price to come into this fair value gap, because this fair value gap, as we have established, fair value gap is a magnet. It magnetizes price towards itself, and when price gets into this fair value gap, it will definitely will reject price. So now let's see what it does, what eventually did. Now look at this now. Now it eventually magnetizes price towards itself. Now that point where there is a reversal, you understand, where there is a change in direction, that point is called what? Swing point. Okay, or you can call it swing high. Okay, this is an old swing high. Okay, now when that this point where price changes is called what? Swing low. Okay, swing low. This place is also called swing low. Okay, now just take a look at that. Now what we should be trading now is that what? We should be trading off of this what? Fair value gap. This is an opportunity for us now to place a buy, then we trade towards what? This swing point. So our boundary is going to be between this fair value gap and this swing point. Okay, because when price comes into this fair value gap, it has the tendency of what? Pushing price away, because it is a strong zone in the market. And funny enough, this is what? Weekly time frame. So if say this is weekly time frame and we are day trader, you are going to take your trade on the lower time frame, which is your what? 1 hour, or probably your what? Your 4 hour time frame. Now by the time price comes into this fair value gap, when you go to your what? Your 1 hour time frame, and if there is an entry confirmation, you continue to what? To ride it up. And before price gets to this place, you would have made a lot of money. Day one, day two, day three, day four, day five. You would have made a lot of money coming into this swing point. So this is going to be your what? Your boundary. Don't trade beyond this boundary, because your take profit should be between before the swing point, because there is tendency that when price gets to this swing point, it will revert, it will reject price. Okay, so when it rejects price, what will happen? You will begin to lose your what? Your money, and you will run into what? Into losses. So now what happens eventually is, now can you see that? So price came into the swing, into the fair value gap now, and when price comes into the fair value gap, so you should be trading within what? Within this boundary. This boundary is your contest. Is your contest. Okay, you should be trading with this boundary. From year to year would have made you a lot of money, a lot of money. You understand? So now let's take a look at what eventually happened. Now can you see, like we said earlier, fair value gap is a magnet, and it's a rocket. It rejects price. Can you see, when price comes into it, it rejected price. Can you see, it pushed it away with bullish candles? Can you see that? So when it pushed it away with bullish candle, what happens? Look at it. Price went up, straight up. When price went up, straight up, it broke this swing point. Now you would have been out of the market in huge profit. You understand? Because you wouldn't know if price would broke this will break this swing point or it will reverse. But now you are out of the market already. That is how to trade. You need to understand the language of price. When you understand the language of price, the world of what profitability in forex trading will be open unto you. Now, this area whereby we had whereby price came into the fair value gap, you know, so this area now, fair value has been offered. Can you see the first swing, the second swing, and the third swing upward? Fair value has been offered. Now, the area where fair value has not been offered is this part now. So we expect that price will go up and still come back. Now, this area where fair value has not been offered is called what? Fair value area. Another entry opportunity for you to enter to ride the market upward. Okay, now let's take a look at it. Let's take a look at it. Can you see? Can you see the three swing points? The arrow up, arrow down to the fair value gap, then fair value gap pushes it away and it broke what? The swing point. So now let's take a look at it again from another perspective. So I've been able to use a blue line to what? To separate it for you to understand it. Okay, this is an area where fair value has been offered. Okay, now this area now where fair value has not been offered is called what? Fair value area. It's another strong zone, another PD array that we are talking about. Look at it. Can you see? This is the area at the moment. Can you see? This is the area where fair value has not been offered. It's called what? Fair value area. These are the three PD arrays that we listed out, and you must understand them. You must understand this PD array. And funny enough, in our next video, I'm going to be exposing your mind to a whole lot of things that you need to know. See, trust me, forex trading is easy. So that is why you have to subscribe to this YouTube channel and you press notification button so that the moment I drop the video, you will get notified. All right. So now look at it. We are expecting that price will come into what? This fair value area. Now look at it. There is another fair value gap here. Okay. This fair value gap has been mitigated. It pushes price up. It created a new fair value gap. Now price should come down into this fair value gap. This fair value gap will push what? Price away. This area where fair value has not been offered is called what? Fair value area. Now let's see what price will now do. Let's see what price will now do. Can you see? Price eventually came into the fair value gap, and what fair value gap did what? It rejected price. It is a rocket. It rejected the price. Initially, it magnetizes the price towards itself. This is another opportunity for you to enter here. Then you place your stop loss below it. You understand? Because our aim is that price will reject it. Will this fair value gap will reject price because there is no way that price will come down to take you out because fair value gap is expected to push price away. So when you place your stop loss here, you enter here, you target the next swing point, which is swing high, because you wouldn't know if this swing high will be broken or if there is going to be what? Rejection to the downside. So that is why your 1:2 is enough. So you target the next swing high and you have made a lot of money, $20,000 to $50,000. Okay, that made a lot of money. Can you see this fair value gap pushed the what? The price away with full what? With full force. Now eventually you would have been out here, you understand? Then you now wait. Now this place now, fair value has been offered. Now that this place is broken, this high is broken, this swing point is broken, then you now wait. Can you see a new fair value that has been what? Created again. You wait for fair value, you wait for price to come into the fair value gap. The moment price comes into the fair value gap, you enter off of the fair value gap again, you target the next what? The next swing point. Then you place your stop loss below it. Then as price goes up, you would have been out of the market before price eventually reverse and retrace downward. Can you see? If you have not if you have targeted this place and you place your your TP up here, and you were not in the market when price was doing its thing, you understand, you'd have lost all the money that you made, and you'd have run into what? Some losses too, because This price action would have taken you out of the market. But now look at it, you traded three times and you made a lot of money. You understand? You traded from here to this point and you made huge profit. And you traded from here to this place, you made huge profit. And you continue and you made the third one huge profit. That is how to trade. You need to understand some zones in the market. It is very important. When you understand these zones, you'll be able to trade the right way. Your 1:2 is more than enough to make you profitable. Your 1:2 is more than enough to make you pass the prop firms. Okay, now let's look at this price action now. This is the last fair value gap that was created by this what price leg, right? So we are expecting that what price will come into it, and then this fair value gap will reject price. Now you'll be trading within this boundary because you wouldn't know if when price gets to this swing point, it's going to break it or it's going to reject and price will fall. So what you have to do now, when price comes into this fair value gap, you place your entry, you enter off of this fair value gap, then you target your 1:2. Your 1:2 should be somewhere around there, so that when price gets to this point, you would have been out of the market in huge profit, and you will now wait to see what price will do next. Okay, can you see? Eventually, price came down into the fair value gap, right? Now the fair value gap pushed price away. Now you are out of the market in huge profit. Now can you see when price pushed through what this swing point? This swing point was able to reject price. Can you see with what with this pink candle? So it's obvious that what this swing point is going to reject price downward and price will start falling. Now look at what happened. See, you are already out of the market in profit before price was fell. But if you had not, if you had placed your what, your take profit above this place, maybe probably because you want set to target 1:3, 1:4, 1:10, you understand? The market wouldn't have gotten to your profit, your TP, then it would have reversed all the money, the hundreds of dollars that you've made. You understand? You would have lost those money, and you would have the price would have taken you out in losses. It would have taken your stop loss out. You would have made huge losses. All right. So now take a look at the next one. This is a bearish trend. Now look at this bearish what? Bearish trend. Now, when price is coming down in bearish trend, it creates what? Bearish what? Fair value gap. So look at the first candle, look at the second candle, expansion candle, look at the third candle. Now, it is expected that what? Price will go up into this fair value gap, tap into it, and what? The fair value gap will reject it downward. Now, as price was coming down, the moment price reverse, it will form a swing point, or you can call it swing low. You understand? If it is up, it's called what? Swing high. So this is swing low, right? Now look at this too. This is a swing low. That point where price changes direction upward is called what? Swing low. Okay. So we now have another swing low now. So you wait for price to tap into this fair value gap. So then the moment price taps into this fair value gap, then this fair value gap will definitely reject price downwards to the downside. Okay. Then you are going to target what? Your your swing low. So your boundary, your trading boundary or context will be from this fair value gap to what? To this next swing low. So you have made your profit here. If parametric price breaks through this what? Swing low, then you wait for another opportunity to ride it down again to target the next what? Swing low. Now let's look at what eventually happened. So price eventually broke this swing low and came down. Now as it came down, it created a new fair value gap. So price is going to tap into this new fair value gap again, and what this new fair value gap will push it down. Okay, so as you keep pushing it down and you keep trading downward too, can you see price tapped deep into the fair value gap before it decided to return. You understand? So you would have entered off of here, then you place your what stop loss above this, then you ride the what you ride the market down to what? To this low. Okay, can you see it? So eventually what happened? So price broke down. So price kept on what? Coming down. It created another tiny fair value gap here. Can you see? You would have entered off of this fair value gap. You place your what? Stop loss just above it. Then you target this what? This swing low. Then you continue to ride it down. Now can you see? Price eventually Now look at the price eventually came down. Now when price came down, look at what happened. Can you see price took you, price price hits your what take profit, and eventually even came down a little bit, right? So now let's continue to see what price did. So when price came here, you have made your profit. It has hit your TP. You have made your profit. You are even out of the market before price decided to what to push up with this huge candle. Can you see? A huge candle. So that is because you have been what? You understand the what? The language of price. You know where to take your profits. Okay. You have been playing it very safe and very simple. So if it has been someone who has placed a TP somewhere around there, and there is stop loss here, and price came in and tap, you would have the such person would have made a lot of money. But what eventually happened is that price reversed and hit the person out in what? In huge loss. That is how to trade. This is just a snip, you understand, a tip, you understand, from all of the stuff that I'm going to be what teaching you. So the next video is going to expose a whole lot of things to you, and that will be released very soon. So subscribe to this YouTube channel, press the notification button. As soon as I drop the video, very soon you are going to get it. All right, thank you.